with that, we come towards the last panel discussion. Multi-asset investing, diversifying portfolios amid global uncertainty. For that, I would request Mr. Uday Dhoot, co-founder, Venn Wealth, moderator, Mr. Chandru Badrinarayanan, Chief Operating Officer, Blue Sky Analytics, Mr. Pranav Pai, founding partner, 314 Capital, Ms. Arpita Vinay, Managing Director and Co-Head, Centrum Wealth, Sushma Kaushik, Partner, Aavishkaar Capital, Mr. Mitesh Agrawal, Founder and Managing Partner, NovumLake Partners. A big round of applause for all of them, everyone.
Hi, good evening, everyone, and we will quickly start. I know this is last session, end of the day, so we have a very diverse set of speakers here with us, representing impact investing, climate change, private equity investing, and in the real estate side. So we'll try to cover as much from these different spaces as we can in the next 45 minutes or so. If you have any questions, do keep them for the end, and we'll try to see if we can take them up as well. Pranav, I'll start with you. Over the last 12 months or 18 months, private equity investing, not just private equity, private investing, both debt, equity, has seen a lot of stuff happening in India. How do you see that whole space? What all is happening? Where are the opportunities? And just give us a general sense of the whole space.
Sure thing. Thank you, and great to be here once again. So we've thought of the private equity space in India having gone through 3 cycles so far. Pre-GFC, maybe pre to 2010 really. We had a few first-time fund managers setting up shop in India. Almost 95% of their capital was global. So large fund of funds, institutions, pensions, endowments, all who were pretty enamored by this India story. The IT guys had gone listed in the NASDAQ. IFOS had been quite a good IPO. Of course, after the dot-com crash, a lot of that value was eroded. But the India story was finally seeing its first global flavor. That cycle of PE, as all of us know in the room, has not done very well. In fact, some of those funds have still not exited. And it left a poor impression globally. I can argue we're still recovering from this, those of us that are new in the industry, but that's been a very important part of India, that the story and reality are 2 very separate trends and signals, and not to buy one over the other or over-index. I think the heart of PE was established post-GFC, and you saw a much deeper appreciation of reality in India. That's number 1. We saw founders now understanding how to work with private equity, and it was becoming more and more mainstream. And whether, of course, the first deals were control and so on. Venture, as we know today, was very rare. But that really set the roots for what we have today, which is a multi 10,000 crore industry, large FDI, nearing $500 million, and committed capital definitely increasing every year. And finally, the third wave was what I would call the internet wave. And every private equity firm has a sizable position in India internet, whether it's startups, whether it's tech-enabled businesses. The recent IPOs were obviously evidence of that. And I think that's led to a very different thinking, and we've gone mainstream culturally as well. So those are the 3 big waves that we've gone through private. Of course, credit, venture debt, new products have come up to service gaps in that ecosystem. And today I'm very proud to say that our founders definitely know how to work and respect capital. That's number 1. Number 2, the markets have matured, and Indian LPs are now a sizable chunk of most of the private equity funds being raised in India. And third, the GPs can now very proudly stand on their own feet and say, we've gone through exit cycles, we've shown success, we've shown DPI, we've shown returns. Of course, plenty more returns to come. But I think that was important, and it's taken us, I would argue, 20 years to get to the point where now we can very proudly and confidently state that Indian private is a commendable asset class overall. So that's quickly how we see things and how it's evolved over the last 20 years.
Interesting. Kind of Shark Tank has also led to many other people wanting to invest in startups. Ki mere ko bhi isme dalna hai, kind of a thing. Chandru, you represent a very different, you look at this whole business or businesses from a very different angle. You did ESG for very long. Now your focus around climate change. What is climate change? We hear this term. What is this, and how does it impact us from a business, from an investment perspective?
Yeah, I mean, climate change simply is global warming, you can say. And global warming is actually being caused by plenty of emissions. And emissions are actually coming from mostly fossil fuels. And, you require more fuel, more energy as the populations grow and as the per capita consumption grows. So all these emissions are actually causing a lot of stress to the climatic conditions, which are very sensitive. So you would know that as per the Paris Accord, all the effort of all countries is to actually contain the temperature to 2 degrees centigrade maximum compared to the pre-industrialized levels, and if not actually 1.5 degrees centigrade. We are already there at around 1.1, 1.2 degrees centigrades, and this is causing a lot of havoc across. And this is actually happening with more intensity and more incidents. This is affecting businesses. This is affecting countries. This is affecting global economies in a different way, and it is affecting individuals. Take the Bangalore floods. Take the Chennai issues which have been happening. Take the frequent floods and other things which are actually happening in countries like Pakistan, the droughts in China. So if it's happening in other countries, it does affect us. So there is a cascading effect of all these things. And that's why there is a global effort to actually make uh, ensure that the emissions are actually coming down, and that does not lead to actually a lot of stress all across. So that's the initiative, I would say.
All right. I think a good switch to you, to Sushma. You focus on impact investing, uh, climate change, private equity, put this together, do the impact. What is this all about? How are investors, are HNIs actually looking at this segment? Why are they looking at this segment?
Sure. No, thanks so much for having me over. So very quickly, impact investing has kind of gained prominence in the last few years, is what we are seeing. Of course, we've been doing work in the impact investing space for over 20 years now, and mostly our investors were global investors, partly for the reason that Pranav mentioned. So a lot of capital was flowing into the impact space from global investors, institutional investors. But between 2019 and 2021 is, I think we've seen a shift domestically in impact investing in India, where close to 600 impact enterprises have raised about $14.5 billion across multiple transactions. Some of the mainstream sectors or impact sectors that have gone mainstream are sectors like microfinance. Agri-tech has suddenly taken the forefront. Climate is an emerging area. So the last 2 years saw close to $600 million of capital flow into climate deals. And this is where we are seeing now domestic investors, both institutional and private wealth, also waking up to recognize the need to be responsible investors. So when we say impact, we're talking of aligning ourselves to the sustainable development goals, which is no hunger, no poverty, climate awareness, gender equality, equality of all forms, livelihoods being a focus. And those are the kind of businesses that people want to put money to. And these are businesses that are generating market returns. And so it's a win-win for all. And we're seeing a lot of interest in that area.
Interesting. Mitesh, you come from a very, very different side, which is basically real estate. A fairly loved asset class for Indians. We own a fair amount of real estate, but when it came from a fund investing point of view, it was something which struggled. So, how do you see the real estate investing piece now with interest rates going back up again? They were at multi-year lows. They're going back up again. Inflation is high. How does it compare with what is publicly listed and available in form of REITs, etc.? So how do you see this whole opportunity?
Yes, so real estate investing has been quite interesting. I would say there have been two major cycles in India, starting from 2005 when the industry really started, and very different period from 2005 to 8, everything going up, and all kinds of crazy strategies and locations and structures and asset classes, and most people ended up losing money. Because of post the global financial crisis, and nothing happened for about 3 to 4 years, and then the second cycle really started about 2012-13 onwards, where people realized that they can either do debt in real estate or buy assets rather than doing equity as such. So people who went on the residential debt side unfortunately got caught up in the wrong residential cycle because the sales volumes in the residential really have been going down since 2013 till about last year. And therefore the NBFCs as well as the debt funds in real estate have really not done well in the second cycle either. But the second set of people who went in the commercial asset buying side, people like Brookfield, Blackstone, New Vernon, where I was working, we had a great run because we were buying assets at about like 11 to 12% yields. These were, and rents went up over this period, doubled over that period, and these were levered assets as well. So in some sense, got lucky in terms of all the cylinders firing at that point in time. And now we are again at a very interesting point in time. Like you said, is inflation, which is rearing up its head. Interest rates are going up. But fundamentally, all the subclasses of real estate are performing very well today. So residential is on an upcycle after about 7 to 8 year lows. Residential sales volumes are really now exceeding what we had seen in 2013-14 period, after a long period. Commercial real estate, office real estate, this current year, 2022, is about 90% of 2019, which is not bad. There were 2 quiet years during the COVID period because of work from home and other things, but by and large, commercial is recovering. Retail, again, post-COVID is doing exceedingly well. Of course, there is a big divergence in terms of winner take all everything, where the best malls perform very well and everybody else just has to close down. Warehousing, again, is sort of doing very well. So it's a very interesting period at this point in time where the fundamental subclasses are performing really well.
Very interesting. Coming back to the private investing side, Pranav, from a wealth manager standpoint of view, my clients would tell me that I want to invest in private equity, I want to invest in venture debt, and this is something that we don't get it. We are used to daily NAVs and liquidity very quick, and these are like 5-year, 10-year investment funds. As an asset allocator, how should I be looking at this segment? And the initial bit that you spoke, you largely spoke about the equity side, but if you could spend some time on the venture debt, on the revenue-based funds, a little bit there as well.
Yeah, definitely. I think the smartest advice I got when I was starting out, because we had to decide what kind of AMC we wanted to be, is one of our mentors painted a simple x-axis, and he said, think about a combination of flexibility and loyalty on one side, and high flexibility, no loyalty on this side, and low flexibility, high loyalty on this side. So on this side of the spectrum, you have hedges, the best hedge funds in the world. They'll have, in New York, if most of you would have traveled, if you have friends in the hedge fund industry, they'll have lunch with you. Him and I can talk about Google. He'll be a big bull of Google and lunch. I love Google. It's a monopoly business. It owns 96% of search. It'll give you a nice story of when we're eating appetizers. And then, technical guys like us can give him the other side of the story, right? A lot of things can go wrong. A lot of things that are not being built the way they're advertised. And by the end of lunch, if I've done a good job, this guy could change his position in a second. He can call office, reverse the trades. So hedgies are the lowest loyalty. Many of them are activists now, but they make extraordinary returns if they judge the signal correctly, right? And allocating to this space needs a very different mindset. Your attitude has to be different, your expectations have to be different, and the incentives are very different. The annual carry, high fees, and only the best survive. This is a real apex predator game, right? On the other side, you have VCs like us. Unfortunately, however smart we may think we are, we don't have any option but to hold a stock we've bought for 7, 8, sometimes even 10 years, right? And when we're investing in early stage, especially, the companies coming to us are 2 guys and a laptop. There's nothing to diligence. So all we're doing is taking a leap of faith and saying we will build, hopefully, an entity that becomes a unicorn, a decacorn, whatever, over 8 to 10 years. So we have no choice but to be loyal, and our ability to shift and move out of that asset is almost zero, right? So an allocator has typically made a lot of money here and an absurd amount of money here historically. In fact, the biggest stories today, the myths that are written, the biographies and so on, Tencent with Naspers, Masayoshi Son with Baba, the early guys in Baiju here in India, DMart, Infosys, all those stories will tell you that there's extraordinary value to be created when backing the right companies. And of course, that's why venture and all these things have a role to play. Now, in the middle are where you have new innovation, right? Now, venture debt is an innovation globally. Of course, it wasn't called venture debt until maybe 2014, 2013. Venture debt is an interesting place where you can get the best of both. You have quarterly payouts and you can measure your returns, but at the same time, you have part of the warrants, the action from the venture side. But these things are all symptomatic of good times in general. So they don't last, they're not consistent in terms of long-term reliability. So there are a lot of tensions also in the middle. And this is not a very natural balance overall. So to conclude, I would say as allocators today, you have a lot of options. And I would say that's why the best wealth advisors like you would say, diversify, allocate, think about the highest quality capital with the highest quality managers. But overall, playing the spectrum certainly has done allocators very well for the last 20 years.
So diversify. Chandru, to bring you in, climate change, you are in part of policy framework, etc. And every policy that comes creates certain kind of winners and certain kind of losers. And it's a natural course of play as such. So if you put your policy hat on, where do you see risks emerging for businesses? Where are opportunities? Where are threats?
Yeah, I think I'm part of the technical committee, which is drafting the sustainable finance regulations for India. And within that, the subcommittee on regulations. Now, I think one thing about policies, whether it is to do with a national policy or a global policy or frameworks, these are made to actually bring in more certainty to actually the industry. So that's one thing. So now, if you talk about actually what's happening across the world and where do we actually see which industries could actually get affected and which are the ones where there are a lot of opportunities. In fact, I would say that there are probably many more opportunities because of climate change than actually when you talk about things like risks. So definitely the industries which are associated to say fossil fuel, they're all going to be in decline. We have seen that actually happening in India. So we have seen the EV industry coming up, and I recently drove an Ather scooter, and really, I could feel the power in that. And I know that that is going to be the future. I mean, the electric scooter is going to be the future. There were a lot of actually naysayers who said this is having this problem, that problem, and we have heard that the problems with the batteries catching fire and everything. But this is evolutionary. The moment you actually do, and these are actually inflection points which happened much long back, and these are the ones which are also driven by policies. So electric vehicle, I would say ICE to electric, plastics have taken a beating. But if you take, and there are many other industries which will go into decline. But we have also seen large industry companies which are pivoting away from fossil fuels. Forget about industries. Countries are pivoting away from fossil fuel. Except, the recent instance of the Ukraine war, where people have gone back to coal and everything, which is fine, because without energy you're going to have anarchy. But if I look at opportunities, one is that entire energy spectrum, and it's not just, most people have been just focusing on solar and wind, but that's not the game today, because when more people are just doing on that, there are other things which are coming up. So I would say that biofuels, and in biofuels is not just actually ethanol. So recycle of cooking oil, which is happening. So there is a big industry coming up as far as sustainable aviation fuel for the airline industry is concerned. You've got actually hydrogen, ammonia, and even nuclear energy coming up. So very recently, and I've been speaking about nuclear energy for a long time, and especially a technology called SMR, or small and modular reactors. You also have got actually a lot of other opportunities in the food segment, including things like insect protein, because countries need protein. So there is insect proteins, there are actually plant-based meats, there is actually aquaponics, hydroponics. So many of the segments in the foods value segment, which are actually new age industries, which are opportunities. Then there are companies like us, I can say Blue Sky Analytics, because you require data to solve everything. So we are converting satellite data to actually actionable climate data sets. And we are one of the few across the world who are actually doing this. And without data, you can't do actually, and data is a new oil, or it's always been the new oil. So many of these industries across the spectrum. Then also you have actually countries, I would say that, which are getting into adaptation and resilience. So these are the two other things which are, very, very important segments which people have to track for opportunities. If it's in today's Mint, in the morning they'd spoken about the rice which has been developed by China, where you don't have to actually cut the crop itself. You will get 8 cycles of rice without cutting the crop. So many of those kind of opportunities which are actually coming up across the world.
Interesting. Sushma, in terms of impact investing, there's this whole feels very good, acha kar raha hu, I'm doing good for the society. Does this actually make money for the investors? Like,
If it hadn't made money, names like Blackstone, KKR, TPG, the global funds would not have been able to raise impact funds, right? And these are all some of the names that are raising billions of dollars to move capital with an impact objective, right? And clearly, people see value in creating returns, and that's when the capital will flow in. We've been investing, as I said, for 20 years. We are currently in our 8th fund. All our investors continue to back us, and that's also because that they do get their money back. Many of our funds have done exceptionally well. So there's definitely money to be made if it is put in the right places. And also we need to continuously innovate on new impact products. So like, as you mentioned, climate tech is definitely a VC, PE focus areas, but there are a lot of other products which require different instruments to invest in climate. And so can someone design those products? You know, as asset managers, can we move on asset allocations to such products? That's where the innovation in our business comes in.
interesting. Mitesh, question to you is that you are in the private real estate commercial space. And generally, one issue with real estate is lack of liquidity or lack of getting quick liquidity. Now you have these REITs which are listed in India. How does the private commercial compare with the REITs? What is the opportunity, and why does that opportunity exist?
Right. So good question. I think REITs has completely changed the way investing works in the commercial side. So it's a very viable option. The good part is all the 3 sponsors which are there today in terms of the listed REITs are very strong, high quality sponsors with high quality portfolios on the office side. Plus, more Blackstone retail is coming, and there are others in the offing. So these are strong portfolios, and it's a good viable option. So one can invest in these REITs at about 5.5% to 6% dividend yields, plus on a pre-tax basis, plus about 4 to 5% expected annual growth, which would take the total return to about 9 to 10% pre-tax. Tax is not very high. It would be about, let's say, 8% or so, which is not a bad option for an inflation hedge product in some sense. Historically, family offices have been investing directly into the asset class in the commercial side, buying floors, buying units, some larger family offices even buying full buildings, which would buy. So the private market valuation for some of these commercial assets would be about 8% yield to cost. But then the management would have to be direct. Most family offices would end up buying floors or part strata, which is suboptimal from a long-term perspective because the management quality is not as good and exit is always more difficult and it requires in-house management. So today, there are options in between as well, where there are pooled vehicles when one can buy full office buildings, manage them well such that the exit is taken care of. And at the same time, because these are pooled vehicles, one is investing a fraction of it. And this can either happen under the AIF pool structure, or there are fractional platforms which have now, which are operating. So the REIT market capitalization is somewhere around 63,000 crore across these 3 REITs. And public shareholding in India, non-institutional, would be about somewhere around 10,000 crores. Fractional ownership platforms would have raised somewhere around 3 to 4,000 crores till date across the 5-6 major platforms. And AIFs would be small, would be sub 1,000 crores in terms of the size.
Okay. All right. Pranav, coming to you, from what you said around the fixed income, and you sort of gave that whole spectrum of fixed income within the venture debt coming somewhere in between. But not 100% sure where it sort of goes. We also have a lot of platforms that have come up which allow almost retail investors to invest in startups. Do you have any piece of advice there? Are these things something that one should really look at? And sometimes you'll get like random PDF files coming to you from a client of yours. Okay, no, I attended this Zoom call. This looks very interesting, and you don't even know what to say. What is it that we can do, and what is the typical success rate if you have to give some statistics to our clients?
Yeah, no, see, that's where I think we're making a big cultural transition. When you go outside India, a lot of the world thinks startups are new to India. This is a 5-year, recently 5-year, 8 years. When was your first unicorn? Acha, 2016. Okay, welcome to the game. But entrepreneurship is a very deeply rooted part of Indian culture, going back thousands of years. So we shouldn't be surprised when members of families, whether very senior or even the young ones out of college, they see other founders, they see young companies, and they want to support them. It's a natural instinct, right? So I think that's a good thing, and I think that's why whatever people say about Shark Tank, I think it's great to see the mainstreaming of Indian startups, Indian entrepreneurship. Today, parents are comfortable when their kid says, "Acha, I want to start a startup." It's the same like saying, "I want to be Sachin Tendulkar, I want to be in Bollywood, whatever." So at least we've reached that level now. At least you're marriageable material if you make it. So I think that's important, but at the same time, let's go to the other side, the more professional side. You're competing with, like I said, apex predators for the best startups, the best founders, the ownership on the cap table. The next round of, this is, let's be very clear, India is one of the only scale open markets for venture in the world today. China is not as open. The US, of course, is open, but again, very territorial. So India is one of the few open markets, and you're competing with, like I said, apex predators. So you have to be okay with taking that risk, right? And the balance in the middle is, of course, a smaller part of your overall net worth. Hopefully you have partners, fund managers, your wealth managers now have partner funds, feeder funds, angel funds. So there are a lot of structures now to help you systematize this. But in the end, it's all risk. In the end, you are taking that risk. You're betting on two guys and a PowerPoint. If it's that early, there's no shortcut to taking that risk, right? So I would say, to conclude, we deal with this every day, and it's hard. I can tell you it's hard. We age very fast, but let not that entrepreneurial spirit or the support for that entrepreneurship stop. So I think every family finds their balance. For me, it's a great thing to see that's happening across the country.
Interesting. Chandru, coming back on climate, and you spoke about a lot of things and a lot of opportunities that are coming our way. How does one participate in these opportunities? How does one get into such opportunities?
Yeah, I think there are plenty of opportunities which are actually coming up. We did speak about the opportunities and everything, and the list is endless. Now, one is, I think, you get opportunities like this in the public market space. Definitely, that's one. And, there's something about climate change, about it's a series of events. It's not something like, one day you wake up and then, you get hit by something. So it's a series of events. And there is a series of opportunities also in that. So there is a short-term opportunity, there is a long-term opportunity. And to actually people in the family office who are preparing for, say, multi-generational assets creation and everything, I would say the long-term, one of the opportunities is to, if at all Antarctica starts opening up, then to buy real estate in Antarctica. Because in 50 years, we will probably not be living in the space called the tropical regions, because it will be too hot to live. Today, Antarctica is actually, and I'm talking about 50 years from now, not, today, tomorrow, or anything like that. No, it's not in fact, there are quite a few studies.
By that time, Musk does not take us to Mars or something like that.
No, that's also actually, you never know by that time, but it's only the people who can afford who can go to Mars. The rest of the people, where will they go? So you will still have probably, things like that. And there are actually, global warming is making a lot of geopolitical, risk and opportunities. For example, the Arctic region. See, traditionally, it's the where you have the economical shipping routes. That's where commerce and industry thrives. The Malacca Straits, the Suez Canal, all these things. Now, what's happening is when you go to the poles, the distance between 2 points is very short. As the Arctic thaws, there's a big race to the Arctic as to where the geopolitical shifts are going to take place. And these are the things which actually, if you're looking at a multi-generational opportunity to actually start focusing on. In the near term, I would say that there are risk opportunities. Again, the way to participate that is either through private markets, public markets, or directly investing in startups. And also actually on the bond side and everything, there is a lot of activity which is actually happening on say, sustainable climate bonds or, sustainability linked bonds. These are things, which are actually giving, good investment opportunities. And these will be actually as part of the policy. This is one of the things, which we are focused on, is to actually, because the big issue there is bridging the trust between the different stakeholders. So greenwashing is a big issue. So how do you actually tackle that? How do you get onto all these things? So these are some of the things, which are coming up where, investors can actually start trusting these kind of, instruments much better. So I would say that these are the gamut of opportunities there.
So your last point kind of helps me bring in Sushma. This whole greenwashing thing, like everything you do and then you just paint it nicely, ESG and impact so how do we make that difference? Like, how do you really say what is there? Like, I can tell you, when we look at mutual fund portfolios, almost all fund houses have launched these ESG schemes. You look at their portfolio, look at their regular portfolios, there seems to be no difference. So either companies have figured out a way, or what should we do? How should one really look for?
Impact washing was a word that was coined recently.
Yes.
And very interestingly, just about a month or so back, I'd put it up on LinkedIn. What's the difference between impact and ESG? And very few people could actually give a response to it. Everyone assumes that these are words that are used fungibly between the two. It's the same. I was surprised because many of them claim to be ESG experts. And yes, all of that is happening because there are big pools of capital that is turning.
I don't understand this, so please explain to me what is ESG, what is impact, and what is the difference, at least.
So ESG basically is the back end of any business. All businesses do multiple things, right? Manufacturing, services, products, and so on. But all of them can be ESG compliant if they start putting responsible processes in whatever they do, right? And it can be responsibility towards the environment, towards the governance, towards society, all of that. So having the right board structure with the right governance, that's one step in the ESG direction. Having the right supply chains with responsible vendor relationships, that's another ESG structure. So all of these add to ESG, but that's not equal to impact. Impact is an outcome. Impact is what you are doing good, whether it is in terms of creating jobs, terms of creating livelihoods, jobs that have economic benefit to the people around them, to society, environmental, carbon emissions, all these are impact because there's an output. ESG is an input.
Okay, all right. And when there are companies who are just saying that we do this, how do you guys actually then go and measure this?
That's where the problem comes, right? Because they have to be very, very specific frameworks for measurement. Impact measurement frameworks are globally known. ESG, he's the expert. He will be able to tell you on how ESG frameworks are measured. There are global guidelines for these things, but I don't think we have enough talent to begin with in our country to start in that direction.
Chandru, you want to add?
Yeah, just let me add on to that because it's a favorite topic.
Yes.
One is how do you actually see there are frameworks, but the frameworks have to be implemented. So you do actually have this big problem. Even when you have framework, how do you measure that? So you have a methodology, but measuring that and trusting the data which is coming out is a big issue. So that's one of the things which made me move from ESG to climate change because it's much more measurable. And much more transparently, you can actually get data to do that. For example, when you speak about ESG, how does SNG actually affect your balance sheet of P&L? It's not at all, there is hardly any data which has a correlation, clear correlation between the two. You can say yes, you can measure impact, but even when you measure impact, how does it actually then affect the P&L and the balance sheet of a company? It's not so clear. Well, when it comes to climate change, I'll not say it's an easy game, but the quantification of the risk, and that's where the banks and everybody will be going very soon. You'll see this coming because RBI has actually signed up for something called as NGFS. And the attempt is to actually then, quantify the climate risk of the bank's credit exposures, market exposures, and operational risk. So this is something which is coming.
Very interesting. I'm almost on my last bit here, after which I'll open it up for questions from you folks. Mitesh, uh, we are seeing a lot of these fractional units, real estate companies coming up, companies like PropShare, Strata, and all of them. Like, how does that compare? Now you have like firms like yours, which is in the middle. I'm presuming there's this fractional. You can buy 1 lakh, 2 lakh, 5 lakh, 10 lakh worth of fractional units, and then you have the listed one. So how do you compare? Where are the risks? What do we as investors or wealth managers need to be careful about?
Yeah, so see, fractional ownership of platforms have made investing interesting in the commercial side. So the way to look at it is that somebody could go into the REITs at a slightly lower yields, but with more liquidity and more organized management, or they could get into fractional ownership of commercial units, which is slightly higher yield, but these are single assets which are there. I think one thing which all of us should be careful is in terms of what is the product obsolescence or where this money is going. If these are, let's say, 50, 100 crore transactions and one is buying part floors and floors in a building, a single unit, in my experience over the last 20 odd years, these are not very easy to exit or relatively more difficult to exit than full buildings, which can be managed well and upgraded over a period of time. Things like ESG, etc., are very important for the clients today. Therefore, green certifications, etc., are improvements in the buildings which have to be done, which can only be done if you have full buildings. So that's one thing that one needs to be careful. But otherwise, these are very interesting, structures which are there. Regulation will evolve, and even the platforms are very interesting today.
Thank you so much. You folks have been brilliant. I could have spent 45 minutes with each one of you. I would open up. We have around 5 minutes. If there are any questions from the audience, if anyone wants to ask anything, please tell me, because we have very diverse. Whom do you want that question to be answered by? Any questions? Huh? No questions. Okay. We can pass on the mic to you. Yes.
So I have a quick question to Chandru, or Sushma can add on, because I have been following Chandru, the way he has been instrumental to bring in ESG concept. So is it need of the Indian enterprise, like when different economies are facing different challenges, like India is still an emerging economy, so enterprises need to comply with this ESG requirement just to chase the Western capital, or do you feel this is something should come within of the Indian enterprises, since you have been instrumental of implementing?
Okay. No, good question. I think compliance comes later. And, when I actually do all these ESG sessions and everything, I would say that ESG is not new to India. So, if you look at E part of thing, we are actually been following this, the Panchabhutas, or the air, land, water, ether, and all this kind of things. This has been fundamental to a philosophy for a long, long time. But the issue which has happened is because of the overpopulation, we would actually worship the trees and we will cut down the trees. At the same moment, we would do both. We would worship the Ganga and we will pollute the Ganga. So these are the things, dichotomies which are there in that. But what is happening is when we do that, it does actually come back to us. So we also have this thing called karma, right? Bad karma, good karma. So it does come back to us. And one day, we will see that the water in our tap is not coming. Or in fact, NYT actually ran a article, interactive map in 2020, which said the southernmost tip of actually Mumbai. Do you know which will be the southernmost tip of Mumbai by 2050? This place where we are sitting. So the entire place there, all the Nariman points and everything, where they're building the bridges now and connecting, they'll all go according to that, if we are not actually doing, getting into a resilience. And a very recent cartoon in Economic Times has now got something called as Climate Toon. So somebody is asking a wealthy guy, how are you going to tackle climate change? So he says, I will sell all my sea-facing properties. So those are the kind of things, which are actually there. But the point is, coming back to your question, I think, this ethos is there. and it is actually essential for people to follow those practices. Compliance comes later, and compliance is more to actually say that give you boundaries and clarity and everything, and to say that to normalize and standardize, to see how do investors are able to do like to like comparisons. So that's where compliances and frameworks and everything come. But if you're not following these practices, you're going to get it. Thank you.
Any other questions anyone has? One last question. If not, thank you so much for being a fantastic audience. I hope, like we have always done, we will find solutions to climate change. We'll back good entrepreneurs. And Mitesh, hopefully, will have more real estate investments. Thank you so much for being a great set of speakers. Thank you. Thank you so much, everyone.
A big round of applause for them. Thank you so much. I would request Mr. Suraj Malik to come here for the felicitations. With that, I would also take this moment to thank our sponsors, Northern Arc Investments, KFin Technologies, Axis Assets Management, Nuvama Private Limited, SGX, ICRA Analyst, Jarvis, FinIQ, and Amy Corp. Yes, one picture, please. Okay, Aditya, they would want you to come on the dais for the picture. So with that, we come to the closing. Thank you so much for being a part of this, everyone, once again, and removing time for this summit. Have a great evening. Thank you.